This is not just the story of a billionaire entrepreneur. This is a deep dive into Elon Musk's business strategy, how he chooses industries, how he competes, how he funds his vision, and why his approach looks reckless to some and revolutionary to others. When people talk about business strategy, they usually talk about market research, competitive advantages, and quarterly profits. But when they talk about Elon Musk, the conversation changes. Suddenly it's about rockets landing themselves, electric cars becoming mainstream, and satellites forming a digital web around the planet. It feels less like traditional business and more like science fiction turning real, but behind the spectacle, behind the viral clips and bold statements, there is a strategy. A pattern. A way of thinking about risk, capital, innovation, and time that connects everything from Tesla Incorporated to SpaceX, from Neuralink to the Boring Company, and even to his involvement with Twitter, now known as X. To understand his strategy, we have to begin with a simple but powerful idea. Elon Musk does not start companies to enter markets. He starts companies to change industries. Most entrepreneurs look for gaps in the market. They study consumer behavior. They search for underserved niches. Musk, on the other hand, looks for industries that are broken, stagnant, or moving too slowly. He targets sectors that are capital-intensive, high-risk, and often avoided by typical startups: automotive, aerospace, energy, transportation infrastructure. Why? Because barriers to entry keep competitors away. If you can solve the hardest problems, you don't just compete. You redefine the game. Take Tesla Incorporated. Before Tesla became the most valuable car company in the world, electric vehicles were considered slow, unattractive, and impractical. Large automakers treated EVs as compliance projects, something to satisfy regulators, not customers. Musk saw something different. He saw that battery costs would eventually fall, that climate concerns would intensify, and that software would become central to vehicles. Instead of building a cheap electric car first, Tesla launched the Roadster, expensive, fast, and desirable. This was strategic positioning. It reframed electric cars from eco-compromise to performance upgrade. That decision reflects a core principle of Musk's strategy: control the narrative by controlling the product. The second pillar of his strategy is vertical integration. In traditional automotive manufacturing, companies rely heavily on suppliers. Parts are outsourced. Software is licensed. Batteries are sourced from partners. Musk believed this slowed innovation and limited optimization. So Tesla gradually brought more production in-house: battery technology, software systems, even custom manufacturing processes. Vertical integration allowed Tesla to move faster, update software over the air, and improve margins over time. It also made the company more resilient during supply chain disruptions. But vertical integration is risky. It increases capital requirements. It concentrates responsibility. And if you fail big. Musk seems comfortable with that trade-off. The same logic applies to SpaceX. When Musk founded SpaceX, the aerospace industry was dominated by large contractors working with governments under cost-plus contracts. Rockets were expendable. Launch costs were enormous. Innovation cycles were slow. Instead of accepting that structure, SpaceX vertically integrated rocket manufacturing and aggressively pursued reusability. The Falcon 9's ability to land and be reused was not just a technological achievement, it was a strategic one. By lowering the cost per launch, SpaceX created a pricing advantage that forced competitors to rethink their economics. Reusability wasn't just about saving money. It was about rewriting the cost structure of an entire industry. Another pillar of Musk's strategy is long-term thinking. Sometimes to an extreme degree, public companies are often pressured by quarterly earnings. Investors want predictable growth. Musk has frequently asked shareholders to think in years, even decades. He frames Tesla not just as a car company, but as an energy and AI company. He frames SpaceX not just as a launch provider, but as the foundation for making humanity multiplanetary. This narrative does something powerful: it attracts patient capital. Investors who buy into Musk's long-term vision are often willing to tolerate volatility. They expect setbacks. They anticipate delays. But they believe the upside, if successful, is transformational. That belief gives Musk room to experiment, pivot, and invest heavily in research and infrastructure before profitability arrives. Of course, this strategy depends heavily on credibility. Musk built that credibility early in his career. Before Tesla and SpaceX, he co-founded Zip2 and later X.com, which became part of PayPal. The PayPal exit provided capital. But more importantly, it gave Musk a reputation as a successful entrepreneur. That reputation helped him attract talent and funding when his later ventures looked almost impossible, and talent is another critical component of his strategy. Musk is known for setting extremely ambitious goals and demanding intense work cultures. While controversial, this approach aligns with his strategic focus on speed. In industries where development cycles traditionally take decades, compressing timelines creates competitive advantage. SpaceX achieved orbital launches far faster than many expected. Tesla accelerated EV adoption ahead of legacy automakers' schedules. Speed, for Musk, is not just operational efficiency, it's strategic leverage. There's also a pattern in how Musk sequences his companies. Tesla pushes battery innovation and energy storage. SpaceX develops advanced materials and manufacturing techniques. Neuralink explores brain-computer interfaces. The Boring Company experiments with tunneling technologies. While each company operates independently, there are overlapping technologies, robotics, materials science, large-scale manufacturing. This creates what you might call a strategic ecosystem. Knowledge compounds across ventures. Talent networks overlap. Breakthroughs in one area can influence another. For example, Tesla's advancements in AI for autonomous driving contribute to broader expertise in machine learning. SpaceX's rocket engineering advances materials and propulsion knowledge. Even if the companies are separate, Musk's strategic lens connects them through a shared technological future. Another defining aspect of his strategy is first principles thinking, rather than reasoning by analogy. This is how it's always done. Musk is known for breaking problems down to their fundamental components. For example, instead of accepting that rockets are expensive because they always have been, he analyzed raw material costs. The conclusion? The materials themselves were only a small fraction of the final price. That meant inefficiencies existed in manufacturing and operations. First principles thinking is not just philosophical. It drives cost reduction, product design, and long-term planning. However, Musk's strategy also involves high tolerance for public risk. Many CEOs avoid controversy. Musk often engages directly on social media, makes bold predictions, and publicly sets aggressive deadlines. While this increases scrutiny and volatility, it also keeps attention on his companies. In a media-driven economy, attention is currency. Musk understands that public visibility can accelerate adoption, attract engineers, and influence investor perception, but attention cuts both ways. Delays, product issues, and regulatory conflicts are magnified. So how does his strategy handle failure? One answer is iteration. SpaceX experienced multiple early rocket failures. Tesla faced production hell during the Model 3 ramp-up. Instead of retreating, Musk doubled down, publicly acknowledging problems and pushing teams toward rapid iteration. Failure, in this model, is data. Each setback becomes a learning cycle. This mindset resembles software development more than traditional manufacturing. Build, test, fail, improve, repeat. Applying Silicon Valley speed to hardware-heavy industries is one of Musk's signature moves. Capital allocation is another strategic lever. Musk has often reinvested profits from one venture into another. After the PayPal sale, he invested heavily into SpaceX and Tesla, at times risking much of his personal fortune. This created alignment between his wealth and his company's outcomes. It also signaled conviction to other investors. In business strategy, signaling matters. When a founder risks everything, it changes how stakeholders perceive commitment. Musk also strategically leverages government partnerships. While often portrayed as purely private sector innovation, companies like SpaceX have benefited from NASA contracts. These contracts provided early revenue stability and validation. By delivering cost-effective launches, SpaceX positioned itself as both a disruptor and a reliable partner. This hybrid approach, private innovation combined with public contracts, strengthened its financial base while pursuing ambitious long-term goals. Then there is the concept of platform building. Tesla is not just selling cars, it's building a software-driven platform with autonomous driving capabilities, over-the-air updates, and integrated energy products like Powerwall and